One of the former chairs of the Federal Reserve, Alan Greenspan, talked about issues with the current immigration system, the Dodd-Frank financial regulations law, and income inequality. His comments came during a one-on-one interview at this year's National Association for Business Economics Conference in the Washington, D.C. area. This is 45 Minutes.
Good morning, everybody. I'm here with a man who needs no introduction. Very excited today to pick his brain a little bit about what he thinks current economic conditions are, some of the challenges we're facing in terms of the overall recovery, and then get into some of the policy recommendations that Dr. Greenspan thinks are necessary to solve this stagnant recovery that we're in right now. So, Dr. Greenspan, let's start with a very generic type question. What's your current view on the U.S. economic outlook?
I would say essentially more of the same. That if it weren't for the fact that asset prices were probably still undervalued in part, I think we'd be in a much more difficult series of problems, many of which Larry went over. But we're still in a position where the equity premium on stocks, for example, reached a 50-year high just several years ago, and they've come down only part way. And remember that stock prices over the years have risen by 6 to 7% annually, fairly consistently, with about half being real, half being inflation. And we've had no change for a number of years, which means that, granted, the market was high in 2007, but we have 5 years of fundamentally no change. And so that there is a slight set of pressures, but that's probably the only good thing I can talk about when I say about the economy.
Well, what about, there's been a debate whether or not over the past couple months we've seen economic data turn a bit slower, and a lot of it is being attributed to weather. Do you believe that?
I think certainly part of it is, but we're going to see a very significant downward revision of the fourth quarter GDP, and we're seeing a definite slowing down. One of the problems being we had a very large accumulation of GDP, and the rate of increase is now slowing, which of course brings the level of GDP down. And we are definitely seeing some slippage in industrial production. We keep a weekly industrial production index, and that in recent weeks has come down a bit, partly the result of weather. We're also seeing that car loadings adjusted to the weights of the industrial production index have also started to go lower. I don't think that's anything really fundamental. I think it is essentially a reaction to the excess inventory accumulation and the mistaken buoyancy that occurred in the second half of last year. But it's basically, as far as I can see, this first quarter looks like 2%. It may go up a little bit the rest of the year. That still remains to be seen. The standard models are those extraordinarily complex and very sophisticated structures which did so terribly well on September the 15th, 2008. I was shocked myself because I was a great fan of the Federal Reserve's system, and we missed it. J.P. Morgan missed it. The IMF missed it. OECD missed it. In fact, I'm hard-pressed to find anybody with a hard structure model that got it right. Yeah. And I just finished writing a book saying, what in the world went wrong? This is not the title of the book.
Well, looking more simpler, so equity markets have done fairly well over the past year, a bit more. Are they getting ahead of themselves? Is there any possibility of a bubble there? Or?
Well, the answer to the issue of bubble is no, but that's not the same thing as saying that it can continue higher. Bubble requires a degree of euphoria which is not quite in the marketplace. So that, yes, the market could go lower because of where I would differ with Larry. I think that long-term rates will start to move higher, and that's going to be very difficult to deal with. But overall, that's not where our problem are. The problem lies far more deeper problem that is essentially a consequence of our response to the crisis that emerged.
Well, let's dig a little deeper into this. Why do you think over the past 6 years the recovery has been so muted, or what's your view on?
Well, I agree with some of the things that Larry mentioned. In fact, I would use them in a somewhat different sense. But basically, we're dealing with a situation in which you can see what's going on if you try to construct the GDP in terms of the average maturity of what goes into the GDP. For example, software is 3 to 5 years. Residential building is 75. Haircuts are 1 month.
Yeah.
And what you end up with is a weighted duration average, which basically, if I had a chart, I should have brought my sets of charts, it's been going down gradually and then goes sharply lower. Mm-hmm. The major component of that decline in average durability is the fact that there's been a very dramatic decline in structures as a percent of GDP. In fact, this includes residential and non-residential, they went from over 10% of GDP down to slightly below 6%. That 4 percentage points is a very big number and is translatable in one form or another to where the sluggishness in the unemployment rate has come from and the overall slack that, say, CBO is employing. So that, to me, is where the problem lies. It's not evident that the remainder of the economy, it's not doing great, but it's not doing all that, it's not behaving in a particularly unusual manner. And so that, as far as I can see, the issue here is why is it that we've had such a dramatic decline in long-lived assets and not particularly in shorter-lived assets? And here I think we have to split the structures into residential and business, mm-hmm. and then examine each separately. I've got a fairly long regression, long meaning long in time, which measures the extent to which non-financial corporate business moves its liquid cash flow into illiquid long-term fixed assets.
So buying these assets with the cash on hand. So basically putting your money where your mouth is.
Yeah. Well, they haven't been speaking very much lately. What the data show is very interesting. At the bottom, which is not that far from where we are now, the actual ratio of capital investment to fixed illiquid capital investment is at the lowest point in peacetime since 1938. And we're up only slightly improved from that particular level.
Well, you've sat on numerous boards. Why is that?
Well, it's not so much the boards that you see, and although you do see it as, but I was also, when I was an active member of this organization as a business economist, I was a consultant to a lot of corporations and sat through mm-hmm. the issue of how investment is actually made. And what will happen is a product manager will be asked to present a particular exhibit as to why a certain facility, a petrochemical feedstock or something like that, ought to be constructed. And they will trump out the usual data, which a lot of the membership here, I think, will basically be quite familiar with. And they get an effect after-tax rate of return of 20%, which is terrific. And the management will go and what's the variance? And there is where the big decisions are made. My experience over the years is that it's very much more important to get a narrow variance, which is usually the case in basically cost-saving equipment, than it is to have a market expensive, very high rate of return, but with a significant potential for loss. My experience is more often than not, that stuff is pushed aside. And so what we're looking at is what is it that causes the variance of capital expectations to spread. And here it is really the issue of what, to use a wonderful, useless term, uncertainty. Yeah. Uncertainty is a vague notion, and we have to put numbers on it to get anything useful. And I use this relationship of the share of cash flow going to capital investment in non-financial corporations, and I try to explain it in the usual regression manner. And using the dependent variable being capital investment, non-financial corporate capital investment as a share of cash flow as the dependent variable, and then cyclically adjusting all of the independent variables to remove the multiple linearity, which you can do and which gives you the very useful characteristic of a multiple regression of the individual regressions, each by itself, sums up to exactly what the multiple regression is. So you can essentially see where the particular elements within the regression are affecting the fitted so-called.
What were the results?
Yeah. And I have this regression which goes back to 1970. The R-square is a little over 0.75, but it's a trendless series, so you don't have the biases where you always get these wonderful high R-squares when you've got two, population and the number of warts on a tree go up, But what the data show fascinatingly is that, in a sense, you do get an impact from, the biggest impact, I should say, when the slack in the economy increases. That's probably half the decline or half of the measure as to why corporate investment to cash flow moves. But the rest of it is not. And the rest of it is, a big part is the cyclically adjusted net gross government savings ratio, or net, they're very close to the same. The net savings figure is, I should say, the gross savings figure shows that large government deficits not only crowd out private investment in the longer run, as CBO often states, but I see it doing it contemporaneously. And the reason essentially is that ex post savings in a domestic economy, savings minus investment must equal your current account balance. And what we're seeing here is that if you basically cause an increase in the government deficit, it is of necessity subtracting savings from the rest of the economy.
Yeah.
And I was about to say, that to me is what's causing the gross domestic savings rate to be declining very significantly to the point where now the net domestic savings figure is zero. And if the gross domestic savings is close to zero, which it is, in order to get capital investment, domestic capital investment, you have to add to the domestic savings figure the figure on net borrowing from abroad. And what's happening now is basically we've had a dramatic decline in gross domestic savings and partially offset by a decline in, a decline in the borrowing from abroad. And the result of this is that the capital investment going into the capital stock is declined very appreciably. And that, going through the usual multi-factor productivity, shows why productivity has slowed down so dramatically and why the GDP is stagnant. And my basic view is that unless and until we get capital investment going up, meaning somehow changing some of these components, because the most important one right now is a very different one. It's the spread between the 30-year Treasury and the 5-year note, and that basically is at the highest level in American history, meaning that we are not only discounting the future, but we're discounting the far distant future at a far more aggressive rate.
Well, I'm going to quote your book on this, and then we could talk about remedies. This was interesting. This struck me as our highest priority going forward is to fix our broken political system. Short of that, there is no viable long-term solution to our badly warped economy. So how do we go about what would your recommendations be? Because I guess you have several elements of it. You have the regulation side.
Yeah, no, you're asking me how we fix our political system?
Not how we fix it. Well, I know. I'm asking, how do we start?
Okay. Well, let me start off by saying that my basic view of the way the way the system is structured is that you get a I don't know how to put this, but the regulatory structure, perhaps defined as Dodd-Frank, is not working, and it can't work. And it can't work because it doesn't address what the problem is. There isn't a single issue which occurred in the breakdown in finance. And remember, in 2008, this was not a breakdown in the non-financial system. The non-financial system, in fact, was as in good shape as I can basically recall it. And the result of that system is that all of the problems were financial. And all of the financial problems were of two sides, two forms. One, a failure to fully address the issue of the extent to which fraud is essentially restrained, because fraud is a very dangerous thing for a market economy. I mean, trust is a fundamental issue in the way our system works. I don't think we apply it more exactly. The remainder is largely the fact that we had inadequate levels of capital in the financial intermediary system and collateral requirements for various different types of debt, which tells me that if we didn't have all of that type of problem, we wouldn't be running into serial defaults of the type that we saw, which broke the whole system down virtually overnight. And serial defaults cannot occur unless you have debt. And so my solution to this, which I think will probably ultimately be a major factor, I hope, in any fundamental solution, because what they got now isn't working, is to have requirements that not only capital goes up, but more importantly, that there be mandatory requirements to hold so-called COCO bonds.
You want to explain what
COCO bonds are contingent convertible bonds, which are very much like debentures, but if you put in it, if there are certain pre-crisis triggers as to when and under what objectively measurable conditions that debt turns into equity. And obviously the flotation of those issues cost another 200 to 300 basis points, but that is the true cost of that debt if the alternate is government is going to be bailing us out. And so as far as I can see, if we were to do that, then you eliminate the major possibility of serial defaults in the financial system, which means you can have tremendous declines in the market value of equity. But as occurred after the dot-com boom, nothing. The GDP changes in GDP were barely visible in the period immediately following the crash of the dot-com boom, which really caused the huge losses in 401ks, in households and pension funds, and all various other means in which there is no basically heavy leverage, but you can absorb large amounts of loss. And they did, and that's what I see is basically required to do as they're trying to do, avoid this from, quote, happening again. I've heard that phrase so many times it's tiring because it always does happen again unless we do something.
So what are, as you said, fixing basically this, reducing the uncertainty, how do you see it progressing? I mean, a year from now, 2 years from now, are we still going to be talking about sub 3% growth in the U.S., or do you think some of this will be resolved?
No, I think that until the political system gets restructured in a form in which we have rational budget policies and rational fiscal policies generally, I don't think how we're going to solve this problem. Because the basic problem, I think, is the fact that we have no domestic savings going on. Household savings are down quite significantly. Business savings is not. I think undistributed earnings of corporations, as Larry points out, are actually doing fairly well. But the major losses are in the household savings rate, which used to be 10%, and it's now a small fraction of that. And progressing towards zero. And the structure of the budget is way out of kilter. CBO has got a forecast for the deficit going down next year. I think it's probably likely, but then it goes straight back up. And they're using what I would consider fairly optimistic income and forecasts of income. And so what we've got here is a very tricky problem on policy. Because there's another statistic I haven't mentioned which is relevant here. The sum of finance and insurance as a percent of GDP in the United States, which was 2.4% in 1947, rose virtually every single year till it reached 8% in 2007. Now, that is not, I should say, that is not something basically American. Chinese data show exactly the same thing. I mean, most of the major international economies show that phenomenon, which is essentially saying, no, it is not the issue of bankers trading with each other because these are consolidated numbers. To be sure, that 8% went down to, I think, 7.5% during the height of the crisis, but it's now right back where it is. That is raising the interesting question, is this secular rise something fundamental to the system. And I don't know the answer to that question, but if it is, then Dodd-Frank is actually going to be significantly counterproductive in squeezing down and creating, despite the fact that what they're trying to do, they are creating institutions which are too big to fail, which means that those institutions which would, were they allowed, took the support out from under them by government, you would end up with them going into Chapter 11. Now, there's nothing wrong with going into Chapter 11. It's an extraordinarily successful program which restructures debt. But if it's too big to fail, it becomes a utility, and everyone expects the government to step in, which means that they get their savings for very low interest rates. And it's a terrible misuse of the domestic savings of the society, because unless you have creative destruction, unless you have a liquidation of the obsolescent equipment, you're never going to make it.
Are there similarities there between Japan?
I would think so, because I recall, after the crash of 1989, what became apparent to me is that the Japanese banking system was not calling loans. They kept turning them over. Yeah. And as Larry pointed out, at a close to zero interest rate, which they had back then, that's not terribly difficult to do. But the problem essentially is that Japan does not. I remember a very prominent politician in Japan told me, he said, I went through my analysis of why you had to have creative destruction to get productivity rising and standards of living rising. And you have to allow institutions to go bankrupt. And he says to me, he says, you've analyzed the situation extraordinarily well. The only problem is that is not the Japanese way. Forcing people to lose face is an extraordinarily unethical thing to do in business. And to have a dodgy loan on your books, you would think it's easy to get off. In the United States, before this crisis, just basically wrote them off, and people went into bankruptcy and they came back out. Yeah. But they don't do it that way in Japan. And I think one of the problems that they've had in the stagnation is they have not allowed their system to liquidate.
Should China be looking at Japan?
They are, but not in the way we'd like it to be.
But what lessons, what are your thoughts on what's occurring in China right now?
Well, I think that, if you just look at the basic data on the shadow banking system, it goes straight up. The lending is very significant. And I thought what was very disturbing the other day was that, I believe it was a coal company which went bankrupt. And everyone was waiting to see what would happen, because the presumption was that with nearly $4 trillion in reserves, the People's Bank of China were not about to allow any institution to go bankrupt. And consequently, it was like the GSEs in the United States. It's a very inefficient system because the capital is not moved to more productive cutting-edge technologies. Yeah. The result basically is that they came in, they bailed them out, and it's precisely the wrong signal that could be made at the time, because it's going to make it very difficult to get cutting-edge technologies to have a significant advantage over less productive types of investments, which means that the tremendous growth rate and productivity in China, which has been essentially the result of borrowing from the developed world, mainly by bringing in capital investment with the technologies. The trouble is that a couple of years ago, Thomson Reuters did a study in which they, from their criteria, who were the 100 most technologically innovative companies. 40 were American, 0 were Chinese, which means effectively, if Thomson Reuters is right, almost all of the 8-9% productivity annual growth rates in China are from borrowed technologies. Now, as the Chinese wage rate has moved significantly higher and closing the gap against the developed world wage rates, that productivity rate is going to fall very sharply. And it already is. I mean, you can already, we're looking at a double-digit annual growth rate. It's now approaching 6, depending on how you measure it. And remember that the Chinese figures are not the same as we look at them. They can create whatever GDP they want by just acquiescing in the requirement of a province to build 3 office buildings because they need to put people to work. It wasn't that they needed the office buildings, they needed the jobs. And that is financed by a state-owned bank under instructions coming essentially from the state council. The result is that you get the GDP that's created there, but it may be a see-through building, or it may be, as is more relevant to the problem, excess steel capacity, which is built to create jobs, not to create anything else.
Well, it sounds like animal spirits is a phrase you used in your book. You said basically the impact of a bubble bursting, a lot of that is due to leverage. Is there a bubble in China, in your opinion? And do you think...
There is, but there's a big difference in China. It's very comforting when you have in your pocket $3.8 trillion to do what it is you want to solve your problems. So I'm not at the moment saying that China is about to go bust unless the stuff they're holding, which are U.S. treasuries, go bust. And I hope that is not on the horizon.
I see. And what about, let's bring it back to the U.S. for a moment, income inequality. It's been rising pretty substantially over the past couple decades. What's your view on that? Any policy recommendations, et cetera?
Well, as I point out in the book, you can make you get a pretty high regression R squared if you examine the issue of the various measures of income inequality with 2 independent variables. One is average hourly earnings, or even average earnings for not only hourly but non-supervisory employees as well, and the issue of stock prices. Mm-hmm. That fairly well fits the rise that is going on. First the decline, then the rise in inequality. And the issue is, do we want to knock stock prices down to get inequality better? Because I consider income inequality the most dangerous part of what's going on in the United States. And Larry had a very interesting chart which shows it's going back to where it was in the 20s and the 30s, which is probably accurate. I mean, it's a couple of professors put those data together, I thought, quite effectively. Mm-hmm. So that you can see the deteriorating impact of that on our current political system. And you cannot talk about politics without talking about its impact on the economy, because it has an economic effect. So my basic view is to recognize that what is causing the slow rate of growth in average hourly earnings is basically slow productivity growth, and slow productivity is occurring because the capital stock is not rising sufficiently rapidly, because capital investment is not going anywhere. And that, therefore, we cannot expect to keep borrowing savings from abroad to finance our gross domestic capital investment. We can't do that. And I would just say that we can't, we've basically got to get to the position where we get our economy moving at a 4% annual rate, and in so doing, if we succeed in doing that, that will solve the issue very quickly.
Yeah.
But that does not look as though it's immediately on the horizon. And I just might say parenthetically, I didn't mention the fact that household uncertainty is best measured by the price of homes. For the years 2001 to 2004, there were 1 million additional single-family owner-occupied homes, which essentially meant the whole household formation was going into owner-occupied single-family dwellings. And that was because the price levels were rising and everybody felt very positive about the distant future.
Yeah.
Homes last a long time. As soon as the prices began to turn, the whole thing caved. The actual level of the stock of single-family owner-occupied homes has been going down, or not very significantly, but gradually. And the share of home ownership to total households, which came down very dramatically after the crash, has not recovered, despite the fact that home prices have come back a good deal.
Lack of confidence, uncertainty again.
It's another way of saying that if you are a homeowner, if you are basically, say, a person about to form a household, do you want to take a long-term commitment or a short-term commitment? And it's disproportionately going to rent where you have a very short-term commitment, rather than buy a home which is a long-term commitment. So it looks exactly like the business community's reaction in a different context.
So, in terms of these indicators you're looking at, and as an employee of Bloomberg, on your terminal, what other indicators are you looking at, or what other imbalances do you see that you're monitoring around the world? You
mean my Bloomberg terminal?
On your terminal, yeah. What's your launch pad look like?
Well, when I turn it, I collect certain types of data which I watch every day and intraday. It's exchange rates mainly. At the moment, I'm always looking at what's going on with the yields on long-term debt in the euro area. Because as I say in my book, I don't look particularly hopefully on being able to essentially keep the euro in place unless they go to full political consolidation. And the issue here is that because of extraordinary actions on the part of the ECB, which has essentially said, Draghi said, we will do whatever is required to do it. And when you essentially are putting out a means of financing with very little restrictions, people will borrow it, if you're a commercial bank, whenever they can. So my problem here is the fact that the system is not stable. And until we stabilize it, I'm nervous about that because, they are growing now, but it's a robust 1% per annum. And Greece is going into an election. And the main problem is Greece is solving its government deficit problem, but they're doing it to a large part by so-called primary surplus. They're getting to the point where there no longer is going to be a net cash flow into Greece. Mm-hmm. They're going to have to pay out interest. That's the danger point politically in Greece. And I don't know how it's touch and go on this election there. If Greece goes to the extreme and drops out of the euro, which is not a small probability, I'm not sure what happens.
Interesting.
Whether it's contagious or not.
And is there any other country that is a red flag for you right now in the Eurozone?
No, actually, I mean, Portugal's doing better. Mm-hmm. Spain is doing better. I mean, after being in really serious trouble.
Yeah.
I don't know how Italy is going to be doing with the new prime minister. Mm-hmm. I like Firenze, where he comes from, but I'm not sure what his policies are going to be like.
Well, I guess time for one more question. I'll bring it back to the U.S. And I had read your book this weekend, and you said that immigration was one of the most important but least talked about policies that the U.S. should be discussing right now. What do you mean by that, or what's your...
Well, let me just go back to income inequality for just a second. We could cure a significant part of that by taking our H-1B programs and either eliminating, which isn't going to happen, or basically open up the issue of allowing people who, for God's sakes, get degrees in the United States and then we force them to go home. We have, as all of the measures of education indicate, a unbelievably deteriorating K to 8, grade 8. We cannot manage to staff our very complex, highly sophisticated capital structure with what's coming out of our high schools. We used to be able to do that when we had high class, best in the world, actually. We've deteriorated very significantly, and then it's getting worse all the time. If we're not going to educate our kids, bring in other people who want to come, become Americans, let them in here and let them use their skills, which is what would happen if H-1B were eliminated. That also has a very significant impact on the psychology of income inequality, because H-1B subsidizes the income of everyone in this room, including you and me. And if we were to open up, we would be finding ourselves competing with others at our skills level, and our income levels would not necessarily go down very much, but I bet you they would go down enough to really make an impact, because income inequality is a relative concept. People who are absolutely at the top of the scale in, say, 1925 would be getting food stamps today. It's a relative issue. So you don't have to necessarily bring up the bottom if you bring the top down. And so that immigration has got a many-pronged, especially, there are really two different types of immigration problems we have. One is, what do we do with the 11 million illegals, which is a very tricky problem. All I would say is that maybe half of them are in the workforce. Mm-hmm. If we ever required them to leave the country, our economy would fall apart, because you have no idea, how much structure they build into it. So I think we're making a mistake in the immigration area, which I think, in many respects, could be the easiest thing we could do to solve it.
Okay, well, I was hoping to get a segment in on jazz, but we're out of time, so we'll have to leave it at that. Thank you all very much. I hope you enjoyed that. Thank you, Dr. Greenspan.